Welcome to the Deep Dive. We sift through the information, pull out the essential nuggets, and really give you a shortcut to being truly well-informed. Today, we're diving deep into something that affects, well, a lot of people as they approach that big life transition, reassessing life insurance needs, specifically for retirement. Our mission, to kind of demystify what can feel like a really complex subject, cut through the noise, get you those insights that bring clarity and, genuine peace of mind. It's not just about maybe saving a few bucks.
Exactly. Retirement isn't just a new chapter. It's a major financial pivot point. What might have been the perfect life insurance fit during your working years, well, it often doesn't quite align with your goals once you've stopped working. So we're here to help you understand not just what changes, but really why those shifts matter for your unique situation, and crucially, how to navigate them effectively so your plan truly serves you.
Okay, let's unpack this then. Because we often hear, I bought my policy years ago, it's just set it and forget it, right? But why is it so crucial to reevaluate life insurance when you actually hit retirement? What fundamentally changes?
Well, it's rarely set it and forget it with major financial tools, is it?
Yeah.
Especially with life's big transitions like retirement. The core reasons for reassessment, they kind of boil down to a few fundamental shifts, things that often catch people by surprise. First off, your financial obligations, they often decrease a lot, actually. Think about it. Maybe the mortgage is finally paid off, car loan's gone, the kid's college tuition that's finally behind you. So the original purpose of that life insurance, which was probably to replace lost income for those big liabilities, it pretty much diminishes, maybe overnight.
Right, that makes a ton of sense. You're not trying to replace a salary to cover debts that, well, they just don't exist anymore.
But hang on, are there situations where those obligations don't decrease as much as people think, or maybe new ones pop up? Oh, absolutely. That's a great point. While many debts might be gone, new needs can definitely emerge. For some, it's suddenly realizing, future healthcare costs might be significant, or perhaps wanting to fund long-term care, something that maybe wasn't even on the radar before. Then there's the shift in dependence. Your adult children, they've likely flown the nest, become financially independent. So that often reduces or maybe even eliminates the need for coverage based on their reliance on your income. And your estate planning focus, that fundamentally shifts too. While you might have focused on income replacement before, in retirement, the goal often moves, doesn't it? It moves towards leaving specific inheritances, maybe covering potential estate taxes, which can be pretty substantial for larger estates, or funding specific trusts. This fundamentally changes the kind of insurance you might need, or even if you need it. And finally, we can't ignore the practical stuff, rising costs and health. Premiums generally increase with age, sometimes quite a bit. And any new health issues that pop up in retirement, they can make getting new coverage really expensive, maybe even impossible.
Wow, okay. So this isn't just about minor tweaks then. These are significant life shifts. They really demand a completely fresh look at a financial tool you might have held for, decades even. It's about making sure that policy's purpose still aligns with where you are now in life.
Exactly. But here's what's really fascinating, though. While some folks might think, okay, I'm done with life insurance, actually, tons of retirees still find it super valuable. It just serves different purposes. For instance, think about income replacement for a spouse. Imagine one spouse passes away, and the surviving spouse heavily relied on their Social Security benefits, maybe a pension. That income might now be cut or significantly reduced. Life insurance can be that critical safety net, right? Ensuring the surviving spouse doesn't suddenly face a huge income drop just when they need stability the most.
That's a crucial point, yeah. It's maybe not just about the kids anymore. It's very much about securing your partner's financial future.
Precisely. And another key reason, estate liquidity. Let's say you have a family home, maybe some art, things you really want to pass down. But maybe your estate faces significant taxes. Life insurance proceeds can provide that liquid cash, those funds needed to cover estate taxes or other final expenses. And crucially, that prevents the forced sale of those cherished assets. Nobody wants that. It's also an incredibly effective tool for legacy planning. It lets you leave a specific financial legacy, maybe for heirs, charities, family trusts, even if your other assets are tied up in, say, illiquid investments or retirement accounts. And finally, sometimes it's just about covering final expenses. There are policies specifically designed for those significant funeral and burial costs, taking that financial and frankly, emotional burden off family members during a really difficult time.
Yeah, that's often a real aha moment for people, isn't it? Realizing life insurance isn't just income replacement like when you were working. It transforms into this strategic tool for estate planning, for legacy building in retirement. It really shows its multifaceted role. It's quite flexible. So, okay, if you're listening, thinking, right, what are my specific needs then? How do you even begin to figure that out? What are the practical steps? Where do you start?
It really starts with a clear financial inventory, almost like doing a little forensic audit of your own finances. First, calculate your current financial obligations. Get specific. List any remaining debts, your ongoing living expenses, and try to anticipate future costs. Things like healthcare, potential long-term care needs, maybe even supporting an aging parent. A lot of people think their obligations are gone, but a deep dive often reveals these hidden future costs that life insurance could specifically help with. Second, identify your dependents and their needs. Really think about it. Does a spouse, adult children, anyone else still financially rely on your income or your assets? Third, assess all your other income sources and assets. Everything. Pensions, Social Security, retirement savings, investment accounts, all the stuff that will continue to provide for your family even after you're gone. And critically, define your goals for the insurance itself. Be really crystal clear about the primary purpose. Is it income replacement still? Is it providing an inheritance? Covering final expenses? Something else entirely? That clarity is what guides you to the right type and amount of coverage you might need, or if you need it at all.
That framework is incredibly helpful. It takes the guesswork out of it, doesn't it? It's a structured way to get real financial clarity, making sure you're not overinsured or, worse, underinsured for where you are right now.
Exactly. Now, when we talk about the types of life insurance relevant for retirees, there are a few key ones worth highlighting. Each has a kind of strategic fit. You've got term life insurance. That gives you coverage for a set number of years. Now, many people think term life is something you just outgrow, but actually some savvy retirees find it's perfect for short-term specific needs, like maybe covering a pension gap for a spouse until their own Social Security kicks in, or covering a specific loan that's going to be paid off in, say, 10 or 15 years. It's generally cheaper when you buy it younger, sure, but it can get pretty costly, maybe even unavailable as you get older. That's the trade-off. Then there's whole life insurance. That's permanent coverage, and it has that cash value component. Premiums are fixed, which people like, but they are generally higher than term policies. Still, despite the higher premiums, that fixed nature and the cash value growth can be appealing, especially if you're looking for predictable asset accumulation alongside the death benefit, maybe even looking at long-term care riders.
Okay, so term for specific periods, whole life for permanence, and cash value. What about something more tailored for, lifetime coverage, but without that large cash value piece, which, can sometimes feel like a drag on returns for some people?
Right. That's where Guaranteed Universal Life, or GUL, often fits in. It offers permanent coverage, but usually with lower premiums than whole life. It focuses mainly on the death benefit itself, without trying to build up a large cash value. It's actually become quite popular among retirees who want affordable lifetime coverage, especially for estate planning, because you get that assured death benefit without the complexities or maybe the lower potential returns tied to the cash value in whole life. And finally, as I mentioned briefly, there's final expense insurance. These are typically smaller policies, designed specifically to cover funeral and burial costs. They're often easier to qualify for with simpler underwriting. That makes them a practical choice if maybe age or health makes other coverage harder to get.
Right, that makes sense. Now, here's where I think it gets really interesting for a lot of our listeners. What if you already have a policy, one you've maybe been paying into for decades? How can you adjust that without just starting from scratch and potentially losing all those years of premiums? Are there options?
Oh, definitely. There are several valuable strategies here, and honestly, they're often overlooked. A really common one is simply to reduce the coverage amount. If your original policy was sized for, say, replacing your working income, well, you might not need that much anymore. Downsizing the coverage to reflect your current, likely lower needs can save you a lot of money on premiums. Depending on your specific policy, options like a partial surrender or maybe a term conversion might be available. You'd need to check with your insurer. For whole or universal life policies, you can often use policy dividends, if it pays them, or the accumulated cash value to pay the premiums. This can effectively make the policy self-sufficient, cost you nothing out of pocket anymore. Or you could even use them to purchase additional paid-up coverage, increasing the death benefit slightly without more premiums. Another smart move, especially if you have term insurance nearing its end, is to convert it to a permanent policy. Many term policies allow this conversion without needing new medical exams. That can be a huge benefit if your health has maybe declined since you first bought the policy. It locks in coverage permanently. And for those with larger estates thinking about taxes, utilizing life insurance trusts is key, specifically irrevocable life insurance trusts, or ILATs. Putting a policy inside an ILAT can protect the death benefits from estate taxes and potentially creditors. It's powerful. But it's crucial to understand setting up an ILAT usually means giving up control over the policy. That's the trade-off. Often worthwhile for significant estates facing big tax bills, though.
Okay, so lots of ways to optimize existing policies. That's really useful. But what if someone listens to all this and decides, actually, I think I do need new coverage entirely at this stage? Is it generally a good idea considering those rising costs you mentioned earlier?
Yeah, it definitely requires careful evaluation. It's not an automatic yes or no. Premiums, as we said, rise significantly with age and any health issues, and the medical underwriting process can be challenging, you have to look at the cost benefit. Is it worth it? It might be unfavorable if paying those high premiums starts draining your retirement income. That defeats the purpose. However, for specific targeted goals, yes, it can still make sense. Maybe leaving a specific amount to a grandchild for college, or providing for a surviving spouse where other assets just aren't quite sufficient. If you have very specific legacy desires, buying new insurance, even in retirement, can still be a beneficial option. You just need to weigh it carefully.
Okay, so life insurance isn't the only tool in the box here, right? It feels like we should touch on that. Are there situations where maybe it's not even the best option anymore? Or where other financial tools might fit better into the whole retirement puzzle?
Absolutely. That's a critical point. Depending on your overall financial picture, life insurance might not be the optimal tool any longer. For example, if your assets are genuinely sufficient to cover all your final expenses and provide comfortably for any survivors, well, you might choose to self-insure. That just means you forego traditional life insurance altogether and simply rely on your existing wealth to handle things. It's a valid option for some. Other products, like annuities, can be excellent, especially for providing guaranteed income streams for a surviving spouse. For some people, that regular income is a more direct and pressing need than a lump sum death benefit. And sometimes, honestly, a more pressing need for retirees is long-term care insurance. That protects against the potentially huge costs of nursing home or home care. That's a financial risk that can just wipe out even substantial retirement savings very quickly. So for some, protecting against that risk becomes the higher priority than life insurance. And it's really crucial to connect life insurance to the broader estate and legacy planning picture. It doesn't exist in a vacuum. For example, maybe you have a vacation home you want to leave to one child, but your other child will inherit retirement accounts. Life insurance can be an incredibly effective way to equalize those inheritances among heirs. Especially if other assets are illiquid or just unevenly distributed, it keeps things fair. It's also a very direct way to provide funds for charitable giving after your death. Or, as we mentioned, to cover estate taxes to avoid that forced sale of assets like a family business or home. The key here, though, is coordination. It really is. Retirees really should coordinate their life insurance strategies with their estate planning attorney and their financial advisor. Get everyone talking. That ensures you optimize tax efficiency and that your legacy goals are actually met in the way you intend. It's about making sure every piece of your financial puzzle works together smoothly.
Yeah, that highlights the holistic view perfectly. It's not just about the insurance policy in isolation, is it? It's how it fits into your entire financial picture, your whole plan, your legacy goals. It's about designing a coherent strategy.
Exactly. And just circling back quickly to cost, because it is a major factor in retirement. Remember, premiums generally go up with age and health issues. That can really strain a fixed retirement income. So it's always advisable to shop around, compare quotes from different reputable providers, and maybe even look into group life insurance options. Sometimes through professional groups or alumni associations, they can occasionally offer better rates if you qualify. Worth checking out.
Okay, great point. So to kind of summarize the core takeaway from this whole deep dive, we've distilled it into some key questions. Questions for you, the listener, to really ask yourself. And these come directly from the most impactful insights we've uncovered today. First, what are my current and anticipated financial obligations, including those maybe hidden future costs like healthcare? Second, who truly depends on me financially right now and realistically for how long? Third, what assets do I already have that can provide for my survivors without needing additional insurance? Be honest about that. Fourth, what are my specific, clearly defined goals for my estate and my legacy? What do I want to achieve? Fifth, can I comfortably afford my current premiums? Or would maybe downsizing coverage actually help ease a financial burden without sacrificing critical protection? And finally, Are there other financial tools out there, perhaps even better tools, than traditional life insurance for my current situation and my unique goals?
Those are exactly the right questions. And remember, this isn't a one-and-done conversation you have with yourself or your advisor. It's really vital to regularly review and update your life insurance strategy. That definitely means upon retirement itself. But also after major life events, the death of a spouse, maybe a new marriage, significant financial changes. It also means revisiting your plan if there are significant changes in your health. Or simply every few years as part of your regular financial checkups. Treat it like getting a physical, but for your finances. Because the true value really, it lies not just in the coverage itself, but in that peace of mind. The peace of mind that comes from having a plan that's perfectly tailored to your unique stage of life and your evolving goals.
Absolutely. Reassessing your life insurance in retirement is just a crucial step toward achieving that true financial clarity and that lasting peace of mind. It's about making sure your strategy evolves right along with your priorities and your resources, whether that means keeping coverage for a spouse's security, maybe downsizing to cut costs, or perhaps reallocating assets to other financial tools. Thoughtful planning helps ensure that your life insurance supports your overall retirement goals without becoming an unnecessary burden. It really is about taking proactive control over your financial legacy.
Ultimately, I think this deep dive shows us that financial security in retirement isn't just about how much wealth you've accumulated. That's only part of it. It's really about the thoughtful, ongoing alignment of your resources with your evolving life goals. That's the key. The true value lies not just in the policy document, but in the peace of mind that comes from knowing you have a plan perfectly tailored to your unique stage of life.
Thank you so much for joining us on this deep dive. We really hope these insights empower you to continue your journey of being well-informed and taking control of your financial future.